Morning, everyone. Welcome to our webinar, CPF Conversations, Balancing Housing and Retirement. My name is Cheng Shin. I'm from CPF Board. You have been listening to our own podcast, Let's Talk CPF, just now. And if you like the episode and would like to check out other episodes, do scan the QR code and listen to our other episodes on Spotify. All right. So before I start the webinar proper, let me go through some admin instructions. We have disabled the chat function, so you can't chat with us technically, but we'll be using the chat function to broadcast messages to you. If you have any questions during the webinar, what you can do is you can submit your questions through the Q&A tab. All right. Just a gentle reminder, please do not share any of your personal details in the Q&A function. For example, your NRIC numbers or your bank account details. All right. And of course, if the video is not moving, what you can do is you can leave the session and rejoin the session. Things should be okay by then. Okay, to briefly go through the agenda for today's webinar, I'll be going through how CPF supports your housing needs for the next 20 to 25 minutes. After that, what I'll do is I'll bring on our panelists today, Ian and Alvin, to join me to have a conversation on how you can balance your home ownership and retirement. We also have a Q&A session at about 11 o'clock before we end the session at 11:30. So let's dive into how CPF supports your housing needs. Now, I'm sure most of you would have read the news regarding the current situation of housing market now. You have noticed that prices of HDB resale have been increasing for quite a number of quarters. In fact, I think probably the last 2 years or so, right? And of course, recently, mortgage rates have also been rising, and probably they might not dampen the property demand as of now, right? So in general, prices of properties are increasing as well as the interest rates. So the key question here you might be thinking about is, how much should you be spending on your home? When it comes to servicing your mortgages and buying a property, what we really want to do is to encourage you to buy within your means. All right. So when it comes to your immediate constraints, there are two ratios that you have to think about. Right. So for example, if you are buying an HDB flat, you have to think about the mortgage servicing ratio, the MSR. This is technically a ratio that does not allow you to spend more than 30% of your gross monthly income to service your HDB monthly installments. Okay. For prudency purpose, what we will encourage you to do is to think about paying an installment that is about 20 to 25% of your gross monthly income, right? If you are looking at a private property, you have the total debt servicing ratio to take into account as well, right? So this is about 55% of your gross monthly income, right? Your total debt servicing ratio will encompass, for example, your mortgages, your car loans if you have a car, and your credit card debts. And of course, longer term considerations, what you might be thinking about is that spending more money, whether it is your CPF or your own cash, would have an impact on your retirement in the longer term, right? So one thing you might want to take note is that property prices may or may not continue to rise or appreciate as they used to. You may want to think about whether your property can be utilized as an equity to supplement your retirement in future, right? This is especially true if you are buying a property where the lease is not very long. For example, if you are age 35 now and you are buying a property with a lease of less than 60 years, that may impact how much you can utilize your property as a form of retirement equity when you reach your retirement age. So when it comes to your CPF savings, what you can do is you can use your OA for your housing. I'm pretty sure that's what most of you know, and what most of you are probably here today for, right? So aside from the down payment for your property purchase, most of us will be using our OA savings to service our monthly housing installments, all right? And in the course of buying a property, you would probably use your OA savings to pay for the stamp duties and legal fees as well, right? And for those of us who are on the HDB flats using OA savings to pay for our monthly installments, we are also covered under the home protection scheme, and the premiums for HBS can be paid through your OA savings as well. So one thing to take note when it comes to using your OA savings to pay for your monthly installments is that you might want to know that your savings, your contributions that go to your CPF account will gradually decrease, right, when it comes to your OA allocation. Okay, what happens is that as you get older, past the age 35, right, the amount of money that is allocated to your ordinary account every month will gradually drop, right? Why this is so is because as you age, what we want to do is to allocate more savings to your special account and your MediSave account to help you better prepare for your retirement and healthcare needs, right? These are more important as you grow a little bit older, right? So perhaps one consideration you might be thinking about is that if you are already reaching the maximum amount of cap that you are paying through your housing installments for your OA, for example, let's say your housing installments is about 1,200 every month and your OA allocation is about 1,200 every month as well, what will happen is that when you are past the age of 35, you may realize that some cash may be required to pay your housing loan because your OA allocation now is not as much as your housing installments anymore. And of course, one question that a lot of members do have is how much CPF can they use for their property, right? There are three key considerations when it comes to your property. So number one, of course, the type of property you buy, whether it's an HDB or private property. Number two, what kind of housing loan you're taking, whether it's an HDB loan for an HDB flat or a bank loan. And of course, the last factor would be whether the property can last you up to the age of 95. So if this sounds a little bit confusing to you, what we have done here is to go through two examples. So here we take an example of Claire and Chandra buying an HDB resale flat, right? Their purchase price was $520,000. The valuation of their resale HDB is $500,000, okay? So here, the applicable housing limit here would be $500,000. Why this is so is because your housing limit will always be the lower of your property or valuation price, whichever is lower lah, okay? So in this case, the valuation price is actually lower than the purchase price, and hence why the applicable housing limit would be $500,000. So in this case, Claire and Chandra has decided to go through to pay their their loan through a HDB loan, all right? So what they can do is that aside from the limit of $500,000, which is the valuation price, if they are both able to set aside the BRS individually in their own CPF accounts, they can use the remaining of their OA monies to pay for the HDB loan, okay? So this is a case where a couple, Claire and Chandra, is using an HDB loan. Now, if they decide to use a bank loan instead, same conditions here, the criteria will be a little bit different, all right? So if they are able to set individually the BRS in their own accounts, what they can do is that aside from the applicable housing limit of $500,000, they can use up to another 20% of the valuation price in this case, which is up to $100,000, right? So in total, they can use up to $600,000 from their ordinary accounts to pay for the bank loan for their HDB flat. Right, so when it comes to a property, most of us will require a loan, and it's important to think about what kind of loan would better suit your needs, right? So if you buy an HDB flat, regardless of whether it's a BTO, a resale flat, you have two options, either an HDB loan or a bank loan, okay? So obviously for those who are buying a private property, you only have the bank option, okay? So when it comes to an HDB loan or a bank loan, there are different considerations. So for example, an HDB loan allows you to loan up to 85% of the price of the flat value, while the bank loan requires you to loan only up to 75%, okay? So you can't loan more through a bank as compared to a HDB, right? Which also means your down payment through a bank loan would be a bit higher, okay? In terms of the payment note for your down payment, okay? For an HDB loan, you can either pay the down payment fully through your CPF, through cash, or a combination of both. Whereas for a bank loan, all right, you can use a combination of both as well, but take note that 5% of your down payment through a bank loan must be serviced through cash, okay? So if you decide to take a bank loan, do consider the cash component because at least 5% of the down payment must be made in cash, okay? And as for the interest rate, it really depends for a bank loan because that's subject to a market condition, whereas an HDB loan is pegged at 0.1% above the CPF OA interest rate. All right, so currently the OA interest rate is 2.5%, so an HDB loan now is 2.6%. And of course, if you are on an HDB loan, you can always consider to refinance to a bank loan if that suits your needs. So this can be done at any point through your loan tenure, all right? But do take note, if you start off on a bank loan, or if you have already refinance your HDB loan to a bank loan, you cannot refinance your bank loan back to an HDB loan, okay? So just take note of that. So when it comes to buying a property, usually when we buy a property, I think for most of us, we purely look at the purchase price. And that is very normal because that is the immediate price tag that we see, right? But what you really need to consider when it comes to your property price is the interest that you are going to pay. So what we have done here is to make an assumption. If you were to take an HDB flat based on a 2.6 interest rate of an HDB loan, paid across 25 years and at an 85 loan purchase price, if you are buying a HDB flat for, let's say, about $350,000, in fact, you are paying a total of more than $450,000 for that flat when you consider your interest payments, right? And this is going to be even higher for a private property because of a higher purchase price, right? So just take note that when it comes to buying a property, if you're going to stretch your loan, especially to the maximum tenure and as well as the maximum loan amount, the interest can cost you up to a third of your original purchase price, all right? So this is something you have to consider, not just by looking at the price tag, all right? Do take note of the interest payments that you incur along the way and how much the property will actually cost you through your loan tenure. Right. One way you can easily do that, of course, is to estimate your housing loan and property price based on your income through our first home calculator, right? So simply use this first home calculator, spend about 3 to 5 minutes keying in your details. You can even log into SingPass, I think, to input your details, all right? And we will give you an estimated amount of what we think you can afford with a property, all right? And from there, you can think about your budget and how much you would like to spend in order to buy your first property. And of course, if you are currently, already servicing a mortgage like me, what you can do is to log on to My CPF Online Services, go to your home ownership dashboard, and there we can have a personalized information on how much you can use for your current property, right? That's the great thing about our website today. If you log in through your SingPass, we have various dashboards to provide you with personalized information based on your current situation. So a key question for current homeowners is, if I decide to sell my home, what happens to my sale proceeds when I sell my home? So when you sell a home, of course, you will have a sale proceeds. Generally, what happens is that the sale proceeds will be first used to pay off your outstanding housing loan, whether it's to HDB or to the bank. Next, what we'll do is that we'll refund the amounts that you have used from your OA savings plus the accrued interest back to your ordinary account. And we'll then settle the other sale expenses, for example, your legal fees, before any remaining amount is paid to you in cash. So a very big question most members may have when it comes to selling their property is, how much do they actually have to refund? All right. So the amount you have to refund is the principal amount that has been withdrawn from your OA for your housing, plus the accrued interest on the principal amount, okay? So to help you better understand your own refund, what you can actually do is, again, go back to the home ownership dashboard. You can actually check how much you have withdrawn from your OA savings as well as the accrued interest that has already been incurred, all right? This will be the amount of money that you have to refund to your own ordinary account if you were to sell your flat today, all right? And a very big question that people tend to have about accrued interest is, why do I have to pay accrued interest? Is the accrued interest paid to the government? All right, so obviously it's no. The accrued interest is paid back to your own ordinary account. You can reuse it in future for your next property as well, All right. The key reason why accrued interest is payable is that you have to understand, if you had not withdrawn these monies from your OA for your housing, these savings would have also earned interest. All right. So it is only right to put back the accrued interest to your ordinary account. And of course, you don't have to worry so much about the refund to your OA, because amounts refunded back to your OA can still be used for your property, next property, right? So if you are below the age of 55, the amount that has been refunded to your OA can be used for your next property purchase, of course, subject to the housing limit which I have gone through earlier. If you are above the age of 55, then that's where things are a little bit different. It depends on whether or rather how much you have set aside in your retirement account. Okay, so if let's say you have not set aside the full retirement sum in your retirement account, the CPF refund that goes to your OA will be first used to top up any shortfall within your retirement account. So for example, let's say your retirement sum is $192,000 for someone who is 55 years old today, you have to do, and you have only $100,000, you have to do a top up of $92,000 from the refund before the rest is paid to you in cash. All right. And of course, any amount that you still have in your OA can still be used for your next property purchase. Okay. So let me illustrate a situation of Mr. Tan, who is 55 years old today and decide to sell his CPF, rather his HDB flat. Okay. And in this example, we are looking at Mr. Tan having already spent, or rather his CPF refund in total is about $200,000, right? That's his principal plus accrued interest. He still has an outstanding housing loan of $250,000, and currently his retirement account has $120,000. Okay, let's say Mr. Tan sells his flat at $500,000. Okay, the $500,000 will be used to pay off his outstanding housing loan first, right? And then we will also refund $72,000 to his retirement account to meet the full retirement sum. All right. So in this case, Mr. Tan, his full retirement sum is $192,000. He currently has $120,000. All right. So that's why $72,000 is refunded to his retirement account up to the full retirement sum. Right. And after these deductions, what happens is that he can have a sale proceed of about $178,000 for his next home purchase. So when it comes to balancing your housing and retirement needs, there are a few factors that you might want to consider, all right? Because you have to understand as well that while your SA is used to save for your retirement, your OA savings can form part of your retirement needs too. So when making a property purchase or even servicing your housing loan, there are some things that you can consider for your OA savings. So for example, right, when you take a HDB loan, at the point of making an HDB loan, you have the option to individually set aside up to $20,000 in your OA. All right. So that is one consideration that you can think about, because by setting aside that $20,000, what it does is that you can still earn up to 5% up to 3.5% interest in your OA, or if you decide to transfer to your SA, you can earn up to 5% interest. Okay. And of course, that $20,000 can help you in terms of a safety net, because in case, for example, you were to lose your employment temporarily and you have no income coming in, those savings that are in your OA can be used to pay for your housing loans while you transit to a new job. All right. And of course, the other thing I mentioned about just now also is that you can consider your monthly installments to be lesser than your OA allocation every month. All right, what this does is that it ensures you have a surplus in terms of your OA savings every month that helps you to gradually save your OA savings and build up that safety net as well. The other thing, which is something I went through earlier just now too, which is to minimize your interest. All right, so consider your loan options. Try to see and take a loan that has a lower mortgage interest, because with higher interest, it simply means that you are paying more for your property over the long run. All right, so choose a lower mortgage interest to save on how much you are paying for your property. In addition, what you can also consider is, for example, if you are on an HDB loan, all right, you can make capital repayments where possible, because for an HDB loan, there are no penalties if you were to make lump sum payments throughout the loan tenure. And by making that lump sum payments, what you're actually doing is to reduce the overall loan amount, which consequentially will also reduce the amount of interest you're paying in the long run as well, right? So if you're on a bank loan and you would like to consider this option, do speak to your financier to see whether any penalties might be incurred if you decide to make a capital repayment. And of course, if you are reaching the retirement age, let's say at age 55 or 65, there are other kinds of housing monetization schemes that HDB has that you can consider, right? So for somebody who is 55 years old, there is a silver housing bonus where you can sell your current property and move to a smaller one and get a cash bonus, all right? And some of the monies from your sale proceeds will be used to join CPF Life eventually. So that gives you lifelong payouts no matter how long you live, all right? So for those of you who are above 65, you can also consider the lease buyback scheme. This scheme allows you to continue staying within your same property. What you are doing is you are selling the tail end of your lease to HDB so that you can get a cash bonus and also to join CPF Life to enjoy lifelong monthly payouts. Okay. So if you do not want to consider either of these schemes, you can also consider, for example, if your children have already moved out and have their own homes, you can consider renting out your spare rooms or your flat, for example, to earn regular monthly income, all right? So that helps you to supplement your retirement income when you stop working. So to end off, what I'll say is that remember that your CPF savings, regardless of whether they are from your OA or your SA, they are also meant to be your retirement income, all right? So if you were to exhaust all the savings that you have in your OA, what it eventually means is that you will probably have lesser for retirement as well, all right? So although your SA is primarily for retirement, your OA can be a very good tool to accumulate retirement savings as well. So do take note that every dollar that you spend more on housing could be $1 less for your retirement needs. All right, so I have come to the end of my short presentation here, but before I move on to the panel discussion, I have two questions, to test whether you have been listening in to my presentation earlier. Right, so you should be seeing a poll appear on the screen now. The first question I would like to ask you is that the applicable housing limit for an HDB resale flat is the lower of the purchase or valuation price. So is that true or false? Right, I think I can see some response coming in. Right, so let me close the poll in 3, 2, and 1. All right, I'm glad 93% of you actually got the question right. All right, so the applicable housing limit for an HDB resale flat is the lower of the purchase or valuation price. All right, so to recap, in the example of Claire and Chandra, right, the purchase price was $520,000. The valuation was $500,000, right? So in this case, the housing limit applicable here would be $500K, which is the lower value. All right, I'll move on to the next question. So you have catched me mentioning this earlier, you would know the answer. All right, if I switched from financing an HDB loan to a bank loan, I can switch back to an HDB loan anytime. Is that true or false? Okay, I do see responses coming in. Thank you so much for your active participation. And I'll close the poll in 3, 2, and 1. All right, very great. 96% of you got it correct. So the correct answer is false, okay? So when you decide to take an HDB loan and you switch to a bank loan, all right, you cannot switch back to an HDB loan, okay? So HDB loan is considered a concessionary loan. So you only have a chance to take a HDB loan at the start when you decide to buy a HDB flat, all right? If you have decided to start off with a bank loan, do take note that you can't switch to an HDB loan as well, okay? Right, thank you so much for active participation in the poll. I'll now move on to the panel discussion with Ian and Alvin. All right, so let me now introduce, or rather hand over the time to Ian to introduce herself. Ian, please.
Hi everyone. So my name is Yan. I'm very happy to be here today. I'm currently the Group Director of Housing and Investment in CPF Board. So what I do in general is to oversee the policy implementation and also the service delivery for CPF members in terms of the use of CPF for housing, investment, and also insurance such as the home protection scheme. So on a personal note, I have 3 young children. And I think many of you will know that raising a kid in Singapore is not easy and certainly not cheap. So I strongly believe that it is important to be prudent in housing so that we have spare cash to meet other expenses and also to build up retirement for ourselves.
Right, thank you, Ian. Well, it must be quite tiring to have 3 kids.
Yeah,
I cannot imagine having 3 kids on my own. Yeah, thank you so much. Now I would like Alvin to introduce yourself. Alvin, please.
Okay. Hi, I'm Alvin. I'm the founder of Dr. Wealth. So Dr. Wealth is a financial education company. So I'm here in that capacity to share views and tips on how to better manage your money. And I probably have the problem of a lesser degree because I only have 2 kids, not 3. So, but it doesn't make it easier anyway. Look forward to the discussion.
Right, thank you so much, Alvin. I think 2 kids is going to be a pretty tough job to handle as well.
Yeah, I have done my part. I replaced myself and my wife.
Yeah. All right. So maybe I'll move on to a first question for Ian first, right? Why is a financially prudent housing choice very important, right? Because just now you mentioned about the prudent housing choice, especially for a family with like 3 kids. How is that important in terms of retirement planning?
Yeah. Okay. So in Singapore, typically housing payments are financed using cash and CPF savings. So if we were to be prudent, and to purchase a house within our means, so that means that first of all, we will have more spare cash. And as Cheng Xun has mentioned, the spare cash can then be used to meet your other financial commitments. So I think many in the audience are probably in your 30s and 40s. So you probably will have to take care of your parents as well as your children. So I can imagine that the expenses are certainly non-trivial. Yeah, and also spare cash can also be used to grow your wealth. So you can consider doing a top-up to your CPF account to earn attractive risk-free interest. Or there are also many other investment options. So for example, I think at the moment, things like Singapore saving bonds, T-bills, these are all very popular, right? And for members who are using their CPF savings for their housing installments, I think what Cheng Xun, you said just now, it is very true. Okay, that is every dollar spent on housing can potentially mean $1 less for your retirement. Yeah, so I cannot overemphasize how important it is to start planning for our retirement early and actively, because during retirement, we do not have any income. So if we wish to lead our desired lifestyle and to enjoy a purposeful retirement, it is crucial that we save for our retirement.
Yeah. Thanks, Ian. On that note, right, of course, we do, like I mentioned earlier, we do see a lot of news about how property prices have been increasing, interest rates have been also increasing as well, right? So how do we actually determine, or what are the factors can we look out for when it comes to prudent housing choice, and whether that property is really affordable to us?
Okay, so I think as a rule of thumb, you should ensure that the purchase price of the property does not exceed more than 5 times, the annual household income. So that's the first consideration. Then the other is what Cheng Xun mentioned earlier also, the 2 ratios that you should watch out for, the total debt servicing ratio, the TDSR, and the mortgage servicing ratio, MSR. So MAS requirement is that the MSR should not exceed 30%. However, to be prudent, we encourage our members to keep your MSR to 25%. So in other words, you should not have to spend more than 25% of your monthly income on the mortgage payments. So these are some of the tips that you can look out for.
Yeah, thanks for sharing the tips, Ian. I think I have also heard about a tip from one of our ex-DCE before. I think he correctly mentioned that as a couple, it's actually a good idea to think about living on an income of 1, rather than trying to live on an income or two.
Yes.
And that is also what I'm trying to kind of achieve on my own, right? By ensuring that the housing installments can be affordable for just one individual, right, to manage, rather than having both individuals, paying for the housing installments. Yeah, I think that is also probably one tip that maybe people might want to think about when it comes to measuring the size and the price of their property when it comes to their monthly installments, right? All right, so for Alvin, I do know that you have actually chosen a BTO flat instead of a private property. Personally, I would have thought that someone like you who is very savvy in investments probably could afford a private property. So why do you actually decide on a BTO as compared to a private property?
So there are several reasons. So one of the key reasons is that I'm more of a stock investor. So I find that I'm more competent in that area rather than investing in, say, properties, and which requires a different set of skill sets. And I've never studied that enough, and that's why I'm not very comfortable to fork out a lot more capital to buy a private property. And personally, for a lifestyle perspective, I don't need a private property or have that amenities. I think that public housing is one of the most value for money kind of shelter in Singapore. So I would definitely want to leverage on it, right? Why would I want to go off my competency zone and go and I don't know, play the status game, which I don't fancy. So to me, that is one of the key reasons.
Yeah, that's some very wise words over there. But of course, I think a lot of members do have this concern, right? Because usually for a BTO, for example, unless you are maybe in your mid-20s or what, right? We do know that BTO sometimes take a bit of time to build, maybe between 3 to 5, 6 years. And some people may have the urgent need, to move to a new place rather than wait for a BTO, right? So in terms of just being affordable, what are other kinds of benefits that you have reaped through, waiting for a BTO rather than going straight to a resale? Because as you know, resale prices have been increasing today.
Yes. So I guess it's dependent on the individual context. Like what you say, if the person has to move in somewhere urgently, then I guess it's out of the question to wait for a BTO, right? So for my context was that there was intention to get a place faster. We were looking at resale, we're looking at like sale of balance even. And I don't mind really getting a cheaper place further away from city area, doesn't matter, because I most of the time work from home, even before COVID. So that was my consideration. But my wife loved that BTO project, that particular project. And then she said, okay, we should go and bid for it. So we're going to try, right? So we got it. And so we end up waiting for about more than 5 years actually. But there were other benefits that came from it because when we have children, we were staying with my mother-in-law, and she became a very great help in taking care of the children, and we could really just go about doing our stuff every day without having to worry who is looking after our kids. So I would guess that certain arrangement like this could be made if possible, that can make the wait for BTO less or more easier to accept, I would say. Yeah, so I guess really explore and think a bit more of what you can do during that waiting period.
Yeah, and I think that is something that is very understated sometimes, because having parents to help take care of your kids, for example, can actually save you a bit of money in that sense also, right? Because you might save on things like childcare fees, right? That cost
they still went for childcare, just that you have the sense of security that someone will really take care of the kids rather than a stranger.
Yeah, that is very true. Yeah. And that is something I think I might want to consider when I eventually have my own children as well. Right, moving back to Ian, okay, so we have a thing that we call the negative sale. This is a topic that has been quite in the news recently. So what exactly is a negative sale? Could you let us have some insight as to why it happens?
Okay, so a negative sale is typically, where the selling price is not sufficient, to repay your CPF refund. So Changshin did mention about this briefly during the presentation, but allow me to recap. So when you sell your property, the sale proceeds are used to first, repay the outstanding housing loan, right? So any remaining proceeds from there will then be used to make the required CPF refund. And then if there are still balance proceeds, then of course the seller can keep it in his pocket and maybe use it to offset the sale-related expenses. Yeah, so in a situation where after repaying the outstanding housing loan, the selling price is not sufficient to make the full CPF refund, so that is a negative sale. And in that event, we do not require members to top up the CPF refund shortfall in cash, provided that the sale is at fair market value. So fair market value essentially means that the selling price is at 100% of the valuation price as determined by HDB or a licensed valuer. So to elaborate a little bit more, the reason why, if the sale is not at fair market value, we do require a top-up. It's really to prevent gaming, yeah, because there could be situations, whereby the seller and the buyer, they collude and to declare a lower selling price in order for the seller to refund a smaller amount.
Yep.
Yeah, so in those cases, we do require a top-up in the CPF refund. Yeah. I think just now you also asked, in what scenarios, will this arise? I think there could be many reasons. So, for instance, if the seller had to earlier on take a housing loan where the interest rate is very high, yeah, then it is possible that even upon sale, the outstanding loan is still high, and therefore the sale proceeds are not sufficient to repay fully.
Yep.
Yeah.
So like I illustrated earlier, interest payments can be up to even close to a third, right, of your property price, which really adds up to quite a bit, especially if you were to buy a very expensive property to start with, right? So I guess the key consideration here is that one is the property price when you decide to buy, which is why bringing back to the point of prudent housing choices, right?
That's right.
That's really important,
Yeah.
so as not to overcommit on the property price, right? And aside from that, while servicing a loan, for example, are there any things that we can possibly do or options we can possibly consider to minimize the chance of a negative sale if we eventually decide to sell our flats, for example?
So I think as Cheng Shin has said it also, the key really is to be prudent in your housing purchase. So if you buy a house that is within your means, you probably don't have to take up a very high loan, and therefore you minimize the chance of you having insufficient proceeds to repay the housing loan at the time of sale. So in fact, I think quite critical is, before you even buy a property or think about upgrading, consider very carefully if that is really necessary. Because I think, sometimes, we may be persuaded into buying a bigger property than we need or upgrading when we don't really need to, because of the thinking that property is always a good investment. Yeah. So the fact is, the reality, the data has shown that property appreciation is no longer as rosy as what it was, decades ago. Earlier this year, DBS, they published a report which I found very informative. So I think the title was, "Will Property Still Be Your Pot of Gold?" Something along that line. So the audience may wish to Google it and read it. So according to that report, property HDB, property prices, it used to rise at a rate of about I think 11% 30 years ago. But this property increase has since dropped to only 0.9% 10 years ago. And over the same period for private properties, property appreciation also dropped from 8% to about 1%. Yeah. Of course, I think we know that in recent years, property prices have climbed, steadily again. But I think it remains to be seen whether the trend will continue. So the bottom line really is that we should not expect that property appreciation will always be very strong, and therefore calibrate our housing decisions accordingly. And this can minimize the chance of having negative sales upon sale.
Yeah, that is very true, because I mean, if you look at property as an investment, as with any other investments, they do come with risk as well, right? And it's true that property, especially one that has not many years of lease left, it's very unlikely that such a property, especially the old one, would continue to appreciate. Yeah. So I think, from my perspective, I would think that having a home for life, for example, making sure that you're comfortable staying within the same property for a very long time, actually does kind of help, because I mean, one way of thinking about it is that if I never have to sell my flat, I'll never have to refund, right? So that's another way for me personally to think about it.
Yeah.
Yeah. Right, I just have one more question for Ian as well, and for Alvin, which I'll later come to you too, right? So aside from property, right, let's say if we are just solely focusing on retirement, how can members with excess cash savings, for example, leverage CPF better to save more for their own retirement?
Okay. Yeah, so within the CPF system, there are options, for you to grow your CPF savings beyond what is mandatorily required. So first of all, we have the retirement sum topping up scheme. Yep, so this is where members, they can top up using cash. If they're below 55, they can top up to the special account and up to the prevailing full retirement sum, which is currently $192,000. And for members above 55, they can top up their retirement account up to the prevailing enhanced retirement sum, which is $288,000. So the benefits, of the top-ups are, first of all, you can earn attractive risk-free interest of up to 6%. That's one. And also, members can enjoy tax relief. So if you're topping up for yourself, you can enjoy tax relief of $8,000, up to $8,000. And if you're topping up for your loved ones, you can get another $8,000 tax relief. So altogether, that will be $16,000 in tax relief. Yeah. So I think members, topping up has become more popular in recent years. So many of you have been topping up regularly, and you may wonder, what will happen if I've already met the top-up limit? So in that case, you can also consider a voluntary refund. Yep. So just now we were discussing, about a refund upon sale. But a voluntary housing refund, what it means is that even before you sell your property, you can choose, to also refund to your CPF account. You can refund the full, principal plus interest, or you can refund part of it. And why, this is also encouraged is that when you refund to your ordinary account, you can, of course, also earn risk-free interest of up to 3.5%. And, with the benefit, with the interest compounding effect, I think this can grow up to quite a tidy sum, for your retirement as well. And also, voluntary housing refunds, the monies refunded can be reused, again, for housing if you think there is a need to. And, importantly, we mentioned earlier about negative sale. So doing a voluntary housing refund can also help to prevent that because, for example, if you were to voluntarily refund, let's say, half of your P plus I before you sell the property, when you eventually sell the property, that means that you have less, CPF that you need to refund. And therefore, you can get to keep more cash, for your other needs.
Right. Yep. Thanks for sharing the tips, Ian. So moving on to Alvin, similar question, but maybe in a slightly different manner. We have audience members who are in various life stages tuning into our webinar. So there are people, for example, who may be just starting work, maybe they are planning for marriage or planning to buy a property, or maybe even saving for renovation because there are some costs associated with housing that you can't use your CPF for, right? So what strategies do you have for these younger members, or even older ones, for example, who already have a property but are thinking about saving and using their excess cash, investing or saving outside of CPF so that they can retire better, or to even supplement their CPF retirement?
Yeah, I think it's a big topic, right? Because there are really many options that people can consider and really dependent on the individual context. So I'll just generally speak about it. Let's start with the younger ones, right? So you talk about one of the things that they might be saving up for is renovation costs, right? Which depends on how much they want to spend, whether they want to live in a palace or they want to live in a more kind of normal house, right? So the renovation can be very costly, up to I hear some of my friends were doing 6-digit kind of renovation,
wow,
right? So it can be very substantial, and some of them might be thinking of, should I take a renovation loan? And if that is the case, right, I would say that the person should not take the loan. You try to pay as much as possible with cash, right? And if the person is thinking of, should I do a CPF top-up, or should I save it for my renovation, right? The simple answer is to save out renovation instead of the top-up. Because the top-up, you're going to get 2.5%. But if you take the renovation loan, probably it's about effective interest rate 6-7%, right? So which means relatively that is a more expensive loan, which means the more you should use your cash to settle it. So I guess the whole principle of personal finance is that you want to reduce your cost of debt as much as possible. You always reduce the need for borrowing at a higher cost. Okay, so that's a relative consideration. And then the other side, of course, you want to increase your gains as much as possible, but manage the risk accordingly. So I guess for the younger groups, taking care of minimizing the high cost loans, the minimize it as much as possible, the better it is, right? Your car loan is probably about effective rate is about 7% as well. So rather you pay the car fully rather than go and do a CPF top up in that sense. Likewise, if you take any unsecured loan, 10 to 15%, credit card will be 24%. So there are a lot more kind of interest-bearing loans that young people tend to take because they have less capital and they have a lot of lifestyle demands at the early stage. So I think this part is something has to be looked at. And of course, in terms of long-term investment, they have a longer horizon. They can generally take a bit more risk, right? I would say that the simple way is to invest in a very broad-based kind of index ETF, like a world index ETF, and just do it diligently, dollar cost average over a long period of time. Don't look at it, don't panic, when the market goes up and down. That should give them higher returns over a longer period of time. So I think young people, the biggest challenge is too many lifestyle demands at a very young age. Everywhere also need capital, right? So I guess that is the thing that they need to balance up with. Then for for the older group, I think the bigger problem is more like asset-rich, cash-poor problem, right? They may have a house that's worth a lot, but they can't extract cash flow out of it. Okay, so I do think that planning for multiple sources of income nearing retirement is more important. Right? It could be leveraging your CPF life, right, as a base. And you talk about renting out a room, that also can increase some cash flow from there. Maybe buy some T-bills that can give you like 3% or what, and you can have dividend stocks or interest from bonds. All these kind of things can play up to create that multiple sources of income, and it all adds up together, right, to give a substantial amount. So I would think that would solve that asset-rich, cash-poor issues at the older age.
Yeah, that's a very good tip. And I think that in terms of monetizing their homes, I think that's also a very good option that members can consider, right? Because as we have been seeing, there are actually more people tapping on HDB monetization schemes as well. So for example, maybe when you're at an older age, there's only you and your spouse left in the house, perhaps you don't really need such a big space anymore. And it's probably good to think about maybe downgrading to a smaller flat. Yeah, and even if you want to stay in your own home, you prefer not to move, there's still the lease buyback scheme that you can consider. Those things do help to supplement the income, right? Right, so thank you so much, Ian and Alvin. What we would like to do now is to, dedicate a bit more time to questions that have been asked by our members. So if you have received our email previously, you would have noticed that we have asked you to send us some questions, right, before the webinar so that we can try and answer them. And of course, if you do still have a question during this webinar at this time, you can also send out questions as well. I would first like to apologize that we may not be able to answer every single questions because we do have limited time, right? But we will try our best to answer as much as we can, right? So let me go on to the first question here. I would like to ask both Ian and Alvin, right? This is a member who mentioned that he or she has fully depleted their OA savings for the home purchase. And currently, this member has about $30,000 in the special account as well as $30,000 in the MediSave account, right? So can this member, right, invest the money in his or her special account?
Okay, maybe I'll go first. Yeah. So in CPF, we do have a scheme, the CPF investment scheme, where members can invest OA and SA. So for SA savings, yes, you can invest it after setting aside $40,000 in your special account. But what I do want to highlight is that the CPF investment scheme, because we have many products, available for investment, so this scheme is really targeted at the more self-directed investors who are, who have the financial knowledge and time, to monitor your investments. So also, all investments come with risk. and the investor has to be prepared, that there will be upsides, there will be downsides, losses are possible. Yeah, so investor has to also be able to take some risk. And one more point to add is that new investors, since 2018, before you use your CPF to invest, you do have to fill up self-assessment questionnaire, okay, or the SAQ. Yeah, so in this, as you go through, this questionnaire, there will be modules, okay, to educate you on, the basic financial and investment concepts, and you can also use this quiz to assess whether you think that the CPFIS is really suitable for you. Yeah.
Thanks, Ian. How about Alvin?
I think generally I wouldn't encourage people to invest their CPF SA because the hurdle rate, the interest is 4% plus the initial bonus of another 1% is 5%, right?
Yep.
It's almost very hard to go to the markets and look for a risk-free investment that give you 5%. Right? So I think that is a very good deal that you should just leave it there and not touch it. Yeah, I don't invest my CPF.
That's very wise words from both Ian and Alvin. Right. So the next question, so this is where I'll ask Ian, what are the pros and cons to consider for both the voluntary housing refund and partial payment of loan? Right? Are the interest rates the same?
Okay, so I think what I understand from this question is I think the member probably has a sum of money and you're thinking, whether for this sum of money to do a voluntary housing refund or to do a partial repayment of the housing loan. So I think it really depends on the individual circumstances, your priorities. But what we can offer is, some considerations that you can think about. So I think the first thing to think about is the interest rates, the relative interest rates. So as we mentioned earlier, if you were to do a voluntary housing refund, the monies go to your ordinary account, and which can earn up to 3.5% interest. So I think then you will have to look at your housing loan, right? What is the interest rate on the housing loan? So if it is lower, let's say at 2%, then I think it will then make more financial sense, to put this money, to refund this money to your CPF rather than to use it to repay your housing loan. So voluntary housing refund, as we mentioned earlier, there are also other benefits, like you can reuse it anytime if you want to, and upon sale, it also means that you have less to refund and you can get to keep more cash proceeds. And on the other hand, a capital repayment, I think if it's a bank loan, yeah, you probably have to go through your terms and conditions, yeah, because there could be some penalty for early repayment, yeah, and I think you also have to give bank advance notice.
Yep.
Yeah.
Right, thanks, Ian. So next question I'll have is for Ian and Alvin. Right, this member has a question about repaying their CPF HDB loan. Right, should they do it as soon as possible, or should they consider transferring their OA savings to SA to earn higher interest? Ian, maybe we might want to start off first.
Okay, sure. So I think, again, yeah, goes back to individual circumstances. And think about your objectives. Yeah, so if your intention is to save for retirement, yeah, which I think I do encourage all of us to start planning for retirement early. So then of course topping up to the SA is a good choice. Yeah, because SA earns up to 5% interest, and with interest compounding, this can really go a very long way to build up the retirement savings. And but of course, if your concern is that you're worried that there's the burden, of having a housing loan, every month you have to fork out to monies to pay for your housing loan. If that is your immediate priority, I mean, it is also possible that you consider using a CPF. Of course, you can also use a cash. If your cash it is sitting in a bank account, earning very low interest rates, then you might as well use cash to do the repayment rather than the CPF OA. Yeah.
So for me, I would think that from a personal perspective, right, that the housing loan is usually the cheapest loan you can get, right? Because compared to unsecured loan, credit card, car loans, all those, right? So I always prefer not to repay the housing loan. Okay, so I'm coming here a bit contrary in that view. This is the last loan I will repay, right? Unless I really have a lot of excess money, then yes, right? It's the last loan that I will repay because it's the cheapest loan I can get. and which means that the money could be deployed elsewhere for higher interest, right? Even I think OA to SA would be a better choice than repaying the housing loan, because overall you get higher interest, and the assumption is that the property value, right, does go up. Okay, so of course we touched about that topic just now, and I generally see that, you know, when people invest in properties or what, right, they usually will take leverage, because if without leverage, the returns of property just based on price appreciation is not enough. Like what you established just now is just 1%, right? But if you gear up to 4-5 times, you get 4-5% per year. So I will believe that that is the key advantage of properties, that you can get a very cheap loan, such that your overall gearing eventually will help you with a higher return on the housing prices in the future. So it's that gearing effect that I think makes sense. So I'm not saying that you shouldn't repay the housing loan, just that if you really have a lot of excess cash and you have repay all the other loans that have higher interest rate, then maybe you can look at the housing loan.
Yeah, I think overall it's really about finding a balance in this sense, and maybe having some form of a risk management, right? Because like what Alvin also correctly mentioned, most of the other types of loans tend to incur a much higher interest. I mean, for me personally, what I did was that even before I bought my first property, I decided to transfer my OA to my SA first, right? So what I did was that, you know, I know it's quite difficult, because one thing I have to point out here is that when you transfer your OA to your SA, it is irreversible. You cannot use that for housing anymore, right? You cannot request the CPF board to transfer back to your OA. And that can be a pretty big hurdle to most people, because as we all know, most of us tap on our OA savings primarily for our housing, right? So maybe a good tip to start would be start transferring a little first, right? And maybe thinking about doing that when you're a lot younger, when you have a much longer runway, right, for your SA savings to appreciate. So that was what I did. I started off with maybe like $1,000 and gradually shifting to maybe $10,000, yeah, to ease in the pain, the pain so-called. Right, thanks a lot, both Ian and Alvin. Right, next question for Ian. Well, we have a lot of investment-related questions today, especially to do with CPF investments. Right, so this member is asking whether they can use the balance money in their SA for investment after they turn 55.
Okay. So earlier on, I think at the very first question, we did briefly talk about this. So for members below 55, you only need to set aside $40,000 in your SA before you can use the rest to invest. But for members 55 and above, there is one more condition, which is that you need to also have set aside the full retirement sum. Yep. And if you have done that and you still have 40K in the SA, then you can invest the balance. But like, you know what Alvin has very correctly mentioned, SA interest rate is very attractive. Yeah, so do consider, you know, if you wish to invest, can the investment, the product that you wish to invest in, give you interest higher than 4%? Yeah, so this is something for members to think about.
Right, thanks a lot, Ian. Based on the question, I would think that quite a number of our audience members probably are 55 and above, or perhaps are reaching 55 years old soon. Right, so we do have a planning a retirement talk coming up soon. I think my colleague will paste the link for the registration to the talk. So I strongly encourage any members who are maybe around 50 years old onwards to consider signing up for the talk, because you will learn quite a bit about how your CPF account changes when you turn 55. So that's very good knowledge that you can pick up on all the policies and changes that apply to you when you turn 55 years old. All right, so strongly encourage you to sign up for that talk.
Maybe I just add on a little bit more, right? So we talk about, the hurdle rate is higher at 4%. But I would believe that at age 55, which is very near the retirement, you want to take less risk rather than take more risk.
Correct.
Okay. So, which means that if I would say that even a younger person shouldn't invest in SA, right? I would think that an older person should not even consider investing in SA.
Right. Thanks a lot, Alvin. So we have one question here which is pretty long. I'll try to summarize a little bit. Right. So we have a member here again near to age 55. He is turning 55 next year. He has actually applied for a BTO flat. Probably a second timer, right? The BTO flat will be ready in 2024. So he's asking whether if he was to transfer his OA to RA to meet the enhanced retirement sum at age 55, can he use these savings to pay for his BTO flat when it's ready in 2024? and refund back to the ERS when he sells his current property? Or is it possible for him to only top up to the ERS after he receives the sale proceeds from his current property in 2024? So Ian, would you be able to share some insights to this question?
Sure. Okay. So yeah, I think this member is keen, on transferring savings to the RA to meet the ERS, which is great. Yeah. But if your intention is that thereafter you still want to use the savings transferred for your housing, then I'm afraid that's not possible, because money's top up to the retirement account is really meant for your retirement needs. Yeah, so the transfer, the top up is irreversible. So the monies will remain in the retirement account, and upon retirement, the members will receive it in terms of monthly payouts. Yeah, but for members reaching 55 in general, if they feel that they still have housing payments that they want to settle using CPF savings, or perhaps they wish to buy another house, maybe a small room, a 2-room flexi. Yeah, so it is possible for members to reserve their OA savings at before reaching 55, so that the monies reserved will not be transferred to the retirement account at age 55. So the monies will then stay in the stay in the ordinary account and can then be used for housing as per normal. But one thing that I would like to highlight is that the interest rate in the ordinary account is lower. Yeah, so by not transferring the monies to the RA, members are foregoing the additional interest. So again, members need to have weigh all these different considerations in mind before deciding whether you do wish to still use your OA for housing after turning 55. Yep.
Thanks a lot, Ian.
Okay.
All right, next question, another pretty long question. This is for both Ian and Alvin. Right, so this member is 46 years old and has about $100,000 housing loan outstanding, right? So she's asking whether she and her husband should consider paying off the loan at one go, because they have 4 kids, one currently in university while the others are in secondary school, and they want to understand whether paying off the housing loan at one go with their OA savings can have an impact to their children's university fees, right? Maybe I'll let Alvin share his opinion about this member's situation first.
So I would guess that one way is to look at other options, right? Rather than always relying on CPF to do a lot of things. Is there like a study loan that can take? Because I do believe that MOE does have some tie-up with the banks that you actually don't pay any interest while the person is studying, taking the loan. So that can be one option, right? Of course, if the kid is good, getting a scholarship is another option. I think that there are many ways, not just to rely on CPF. I think it's too taxing, right? Just to try to squeeze everything out of the CPF account. Sometimes certain things have to be funded outside of it. So I would think that have to look for options.
Okay. How about Ian?
Yeah, okay. So I think what Alvin said is very true. So CPF is not the only option, to finance education. In fact, just now what Alvin mentioned was the MOE's tuition fee loan. Yeah. So tuition fee loan, as Alvin has rightly pointed out, the key advantage is that the interest will only start accruing after the student has graduated. Whereas, if CPF is used to finance the education, the interest starts accruing immediately upon the withdrawal of the savings. Yeah, so we have also seen how interest rates can grow quite significantly. Yeah, so that's one advantage of the MOE tuition fee above the use of CPF savings. And another advantage is that for MOE, during times of economic downturn, let's say also earlier on during COVID, right, they do have the flexibility to waive the interest payments, for a certain period. So I think, if I'm not wrong, a couple of years ago, MOE did waive the interest repayable on the education loan, and even in the past they've done it before as well. Whereas for CPF savings, it is not possible that we waive the interest accruing, because the CPF savings are really for the lender's retirement savings. So in times of economic downturn, all the more the lender needs to ensure that he or she has sufficient savings. Yeah. So these are various things to consider. Yeah.
I think it will make the child more independent as well,
Exactly.
right? So once you make your money, your paycheck,
Yeah.
right, pay off your tuition loan, I think that might end up better for the kid.
Right.
Yeah, that's true. I think sometimes, I myself went through a phase where I worked part-time when I was studying, and that kind of helped me better understood
The value of
the
money.
value of money, right?
Yeah.
Yeah, because prior to working part-time, I've never realized how difficult it is to earn maybe $7 an hour.
In fact, I think this is like part of the financial education
Yeah.
that the household is responsible for.
Yes.
Yeah, that's very true. Yep. So moving on to the next question. Okay, so this is about housing monetization scheme, right? So for Ian, so this member is 63 this year, and he or she has a HDB flat that has a remaining lease of less than 60 years. I think the member would like to ask how he or she can calculate the amount of cash they can potentially receive if they apply for the lease buyback scheme when
Yep.
they turn age 65.
Okay, so the specific calculation is done by HDB. So I would encourage the member to find out more from HDB. But very broadly, I think what they do is that they look at the market value of a HDB flat of a similar remaining lease. Then they look at how many years of lease that you intend to sell back to HDB and prorate accordingly to derive the proceeds lah. Yeah. And Cheng Xin did mention this in the presentation earlier, but also just want to echo. LBS, the lease buyback scheme, it is a very good way to unlock, the value of the home. Yep. Yeah. So members, if you were to sell your remaining lease to HDB, you get a sum of money. It can be top up to the retirement account, and with that you can get higher CPF life payouts.
Yep.
And I think you also receive cash bonus.
Yes,
right?
correct.
Yeah.
Right, so there are many benefits when it comes to housing monetization schemes, especially I would say lease buyback, because in a way it also solves the problem of you having to handle the logistics of having to move, right? Yeah, and probably save money on renovation as well. Yeah, so if you are 65 this year, really encourage you to think about, considering the lease buyback scheme, especially if you want to supplement your retirement income and you might have no other options in doing so.
Yeah.
Okay, next question here. I'd like to ask Alvin and Ian. All right, so this member has a situation where his wife has a comparatively smaller OA amount as to him, and he has probably a substantial sum amount of money in his OA. So he is thinking about whether he can top up to his wife's OA to help her retirement, but at the same time, he also has a pretty substantial HDB loan. Right, so should he use his OA to pay for the housing loan first, or to transfer to his wife's CPF account for retirement, or how can he actually balance both these options? Maybe Alvin, would you like to share some insights first?
I think it's the same issue, right? Trying to use CPF to solve a lot of money problems. I think it's just too challenging and too difficult. So there are other ways again, right? If possible, look at outside of CPF, right? Plan for retirement. As I said, one easy way, you want to boost your return, investing in a well-diversified world index ETF, that will help, right? And take a more long-term approach, rather than always looking at CPF and to solve a problem. As I said, even at old age, I do think that designing a multiple source of retirement income is very important, right? It gives a lot more buffer and robustness to that retirement planning, rather than always relying, CPF will go to fund everything that I need. So I think it's a mentality change as well. But it's good that some of the members are thinking about all these options, right? But I think can expand that views a lot more to consider cash, not just CPF.
Great. How about Ian?
So just a technical clarification.
Yeah.
So I think the member was asking whether he could transfer his OA to his wife OA, right? So actually under the topping up scheme, okay, OA can only be transferred to the special account of the recipient, okay, if the recipient is below 55, or the retirement account if the recipient is 55 and above. So this is because all these transfers, these top-ups are meant for retirement purposes, so it can only go to the special or retirement account. So I think it's wonderful, that the member is thinking of helping the wife to build up the retirement savings. So I think from the retirement perspective, it makes a lot of sense, because the member's OA is earning up to 3.5, whereas the SA, RA can earn up to 6%. So collectively, the couple's retirement savings will be higher, if this transfer takes place, and collectively they can also receive higher payouts. Yeah. But whether or not to use your OA to do the transfer or to repay the housing loan, it's like what Alvin mentioned earlier, what we discussed earlier. Whether you can also look beyond CPF, consider using cash, to meet different needs as well.
Yeah, so maybe on that topic, a general question for Alvin. What do you think would be a good percentage of your personal income to consider for investment, your cash investments, for example? Because people do have different needs, right? So is there like a general rule of thumb that you would recommend in terms of thinking about how much should you invest?
It's a good question, right? So there are a lot of demands in life. I need to pay for this, pay for that.
Correct.
So how do I have enough to invest again? The general mantra is reverse it. A lot of people would think of like, I spend, then whatever left, I will invest. Usually it doesn't work that way.
Yeah.
You should flip it the other way around. It's like, I'm committed to invest this amount, and I try to save as much as possible with whatever I have to spend. So that should take the idea of like saving. I would think that at least 10% should be earmarked for savings/investments. Right? And of course, if you can increase that percentage, the better it is. And yes, you do take some sacrifices in other parts of your life, right, in terms of expenses management. But I do think that if one really wants to plan seriously for retirement, some of these sacrifices need to be done. And not only that, sometimes it's also about advancing your career, right, increasing your pay. Think of ways to grow that salary rather than just always cutting costs now. So I do think that it's a two-pronged approach. But the mentality of like really earmarking, no bargains. Every month I'm going to invest 10% or 20% of my salary. Then it will work. Yeah, if it's always like I spend first then I invest, right? Usually there will be nothing left.
Yeah, that's true. It's a very good tip, and I guess that's why CPF takes 20% of the
Yeah,
pay.
exactly.
All right. So to take a short break, what I hope everyone can do is to perhaps help us fill out a feedback form. My colleague will paste a link to the feedback form. We really appreciate if you can help us fill in that form, because you can let us know what you have done well, what other topics you would like to see for other future webinars. You can also let us know where we can improve. All right. So really do seek your help to help us fill the feedback form. All right, I have another question for both Ian and Alvin here. So is it wise to use your CPF money to pay for your housing if you are looking at early retirement? All right, so this one member's understanding is that the CPF requires a minimum sum before he or she can retire in future. Right, so maybe Ian, would you like to clarify first?
Yeah, okay. So the member mentioned in the question, right, that he understands that CPF requires a minimum sum before he can retire. So there's no such requirement. I mean, members, they can retire, anytime you think you're ready. So what happens about this minimum sum, okay, or in fact now we call it the full retirement sum. Okay, just to explain it, what happens is that at 55. Okay, there will be a prevailing full retirement sum at that point in time when you turn 55, and that will apply to you. So at age 55, the retirement account will be created, and monies from the ordinary and special account savings will be transferred to meet this full retirement sum. However, if the members do not have sufficient savings, to meet the full retirement sum, it's okay. It's not like members have to top up in cash. There is no need to. It just means that in future, if members were to when they have the spare cash, if they want, they can voluntarily top up. Okay, but it's not, of course, not mandatory. Yeah. So whether to use CPF to pay for the house, or I suppose the alternative is to use cash. I think, again, this goes back to our discussion earlier. You can think about the various interest rates, right? So again, if your house, the housing loan, the interest rate is lower than the CPF interest rates, then it may not make sense to be using CPF savings to pay for the housing loan. Conversely, if the cash is not invested in like ETFs, or is mainly sitting in the bank, earning low savings interest rates, then in that context, it will be advisable to instead use cash rather than CPF to pay for the house.
Yep.
Yeah.
My understanding of this question is that the person wants to retire earlier. So which means he's probably, or she's probably thinking of like getting cash flow from investment, and the issue is that with the CPF, you couldn't withdraw before 55, right? So that's why I think this question came about, and they want to use the CPF to pay for the housing loan so that the cash can be used to generate cash flow for their living expenses so that they can retire even before 55. So I do think that if that is the case, this person definitely have the financial resources to even consider that. Then one cautionary tale that I want to share would be like what Chen Xue has shared just now. The CPF OA contribution allocation will go down over the years, right? So maybe yes, now you can afford, right, with this kind using your CPF to pay because you're maybe still holding a kind of a job right now. But let's say you really early retire and then suddenly all your CPF contribution is gone. How are you going to make that repayment at the end of the day, right? So even if, let's say, later on you want to go back to your job, the CPF OA allocation will also be lower than what you used to. So there are some this kind of long-term consideration that need to be done when you want to use your CPF for your housing needs.
Yep. And I think what Alvin earlier mentioned is very true in terms of taking a multi-pronged approach, right? So from what I learned, I think with CPF, I think it's not necessarily a bad thing to start using a CPF when you're younger, because for most of us, when we start off our work, of course, we probably will not have that much cash, right? And naturally, I would say it's a tendency to rely on our OA savings, right, for primarily for our housing, right? But as we perhaps advance in our career, like what Alvin mentioned, right, and we get pay raises, maybe there are other alternatives that we can think about, and like what Ian mentioned, using some cash to offset that CPF component can be helpful in terms of helping you to save a little bit more for retirement, right? So that's something that you can consider. Okay, Ian, we have an interesting question here from one member. So he says that he has some skeptical friends telling him that it is not worth to top up to his retirement account because his friends will rather save in the bank, which also provides interest, and they can also withdraw the monies anytime, instead of having to wait till at least 55 years old, right? So how do these options compare, saving in the bank as compared to topping up to the RA?
Okay, so it sounds like the member is probably below 55 years old. Yeah, so in that case, top up it will be to the special account, not to the retirement account. So that's the first clarification. Okay, so comparing both options, I think it depends on the intent, right? For monies in the special account and retirement account for members above 55, these are for retirement. So these are for long-term needs, and therefore they're able to pay higher interest. Okay, so in CPF's case, it is up to 6%. Yep. Whereas bank interest rates, precisely, because there is this flexibility of withdrawal at any point in time, early withdrawal, so the interest rates will correspondingly be lower. So in fact, I think the savings, bank savings interest rates probably now is still less than 1%, right? Yeah. So so of course, you have to weigh, flexibility versus returns. Okay, which one do you value more? Yep. Yeah, and therefore make your decisions accordingly.
Yeah, and I think the key here is to maybe achieve some form of a balance between saving for your long-term future and maintaining some form of flexibility. I mean, of course, with banks savings accounts today, they do offer some kind of a tiered interest rates, right? But that also depends on you satisfying certain criteria, right? And even with fixed deposit rates increasing recently, I mean, there are also conditions attached, right? For example, the minimum number of years you have to hold a fixed deposit, and maybe even the minimum amount that you have to commit to the fixed deposit. So I guess it's really trying to find a balance. Right, so I have a question here. So I think this is maybe more perhaps directed to Ian again. Am I allowed to withdraw my excess SA as I'm currently 49 and I have not reached 55, right? Because currently the interest for bank has spiked a lot, and this member would probably like to settle his or her bank mortgage earlier using his SA balances lah.
I see. Okay, so no SA balance cannot be withdrawn. Okay, so members, the earliest they can make CPF withdrawals will be at the age of 55. So the reason really is because we know, I mean, with inflation, retirement expenses, all these will rise, and therefore we do, want our members to be able to have sufficient, runway to accumulate and build their retirement savings. Yeah, so even if at this point in time you feel that your special account savings is probably sufficient, but it may not really be enough by the time you retire. Yeah, so these monies need to be retained and to earn that interest.
Yeah. Okay, thanks a lot, Ian. Next question, maybe I'd like to start off with Alvin first. Right, so many families have decided to upgrade to private or even bigger houses, wiping out their OA. Generally, the view is that they can decide to sell or downgrade in their retirement years when they need to. So they do this upgrade currently. So what's your current view on the approach?
I guess the biggest assumption is that the property prices goes up. Right? If it doesn't, and negative sale, like what we discussed just now, can happen, and that will jeopardize your retirement. So I do think that it's a very big assumption to make. Still be more prudent, err on the safe side. Right? You really don't know what's going to happen in the future, right? So erring on the safe side would at least have a so-called secure the downsides or minimize the downsides that's going to happen in the future. So I would think go back to the affordability. Yes, you can upgrade, but if it's within your means, go ahead. If it's not, maybe think twice.
How about Ian? What do you think about this approach?
Yeah, so just now I shared about the report from DBS, right? So I think, compared to 30 years ago, the past 10 years, the property appreciation has indeed gone down. These are proven by data. So I think no one can really tell what's going to happen in future. Yeah, so we, encourage members to really, be prudent in deciding whether or not you need to buy a bigger house, whether or not you need to upgrade. Yeah, because it's not assured that there will always be a strong property appreciation.
Yep.
Yeah. So in general, I think again, what it means to be prudent, and just to recap, it really is about keeping your mortgage servicing ratio to below 25%. Yeah, if possible.
Yep. I think those are very good tips. I mean, of course, sometimes we do. We do know members have maybe the need to move to a bigger house simply because they have more family members, right? So I mean that's a very understandable need, but I guess the key here is really to do your proper financial planning, ensuring that you're not overcommitting to the property, and financial prudency is really the key here. Okay.
And maybe just to add on, so I think it's very true. The fact that family, as the kids grow up, you need more space.
Yes.
Yeah, but it doesn't necessarily means that the bigger house has to be more expensive.
Yep.
Yeah, I think living in what we call so-called suburbs, but in fact in Singapore, I think everywhere is not too far.
As a suburb.
Exactly. Yes. So even the slightly more far-flung places, let's say Punggol, Jurong. I mean, all these are also very well connected these days. They have their amenities. So I think we do not always have to stay in the so-called mature estates.
There's joy to be found in every single town.
Exactly.
Yeah, I have another question here. I think this is probably something that might resonate with Alvin. I'm not too sure if it's so, because this is a question from somebody who is self-employed, right? So my HDB is currently fully paid. I'm self-employed. To increase my retirement money in my CPF, would you suggest to do a voluntary housing refund first, or do a top-up first, or maybe even consider other options?
I like what we discussed at length, right? So I guess a lot of the questions are variation of about the same thing, right? What we have established is that having a more multiple sources of income and retirement is a lot safer than just relying on one thing. So it may not be a 1 and 0, right? I must always put everything in a CPF for my retirement. Right? You can maybe do half, right? And then the other half you can invest the cash in something that has a higher return. Right? So that may give you a mesh of average return that is higher than what CPF would be able to give. So I guess that is that central idea that we have been sharing all this while this morning. So I guess that is a good position to be in, right? To have that option to where should I put my money? So I guess a balanced approach is still better than everything goes to a CPF, right? Whether is it voluntary housing refund or whether is it CPF top up, I do think that cash component should not be forgotten.
Yep.
Yeah.
So Yeah, I think Alvin is totally right. But if it really boils down to just these two choices, voluntary housing refund or RSTU, then I think then the member will have to think about your future housing needs. So if you do plan that, you may want to buy a new property, yeah, and if there's a real need for you to, let's say, to upgrade, then you may want to do voluntary housing refund, because the money is refunded to the ordinary account, can be reused for housing. Okay, but if you're very comfortable in your home, it is a home for life, you intend to stay there till you retire, then I think RSTU will be a better option, because the interest rates are higher. Yeah, and with again, interest compounding, it can contribute a lot more to building retirement savings in the old age. Yeah.
Yeah, and I think especially so for self-employed, right? Because for self-employed, the obligation is that you have to top up to your MediSave account.
Yes.
They don't receive traditional contributions that are allocated to 3 different accounts, just like a regular salary employee, right? So perhaps saving more within the special account is actually quite good for them, because they can build that solid foundation for the retirement through the special account, and thereafter, of course, the cash, like what Alvin correctly mentioned, diversify, look at investment tools that are perhaps suited to their needs to create that additional multiple sources of income, right? So that they can have a better retirement. Because I guess for self-employed, it's really a very different case compared to a regular employee.
It could be a case their CPF savings can be lower than a general worker, right?
Correct, yeah. All right, so time flies while you're having fun. So I hope you have enjoyed as much as we do. The time now is about 11:25. I think we still have time for about 2 more questions. Yeah, so maybe I'll direct the second last question first again. So to this member, I presume that he or she is asking about whether they can buy 2 properties with their ordinary account savings, right? So Ian, could you share some insights into this?
Yeah, sure. So I think, yes, you can use CPF to buy the second property as well. But again, before you buy the property, think carefully whether, it is indeed something that you need. So if you have determined and assessed that, you do need a second property, then you can use your CPF savings. However, there are restrictions. So for the second property, the members, they will have to first set aside the basic retirement sum. So just now we talked about the full retirement sum, which is $192,000. So the basic retirement sum is half of that, and that is the $96,000. So members need to first set aside this amount in your ordinary and special account savings before you can use any excess for your second property. Yeah, but also bear in mind that I think in terms of the loans that bank can give, it is also lower. Yeah.
Yep. Okay. Right, so for the last question, I think both Ian and Alvin can chime in here. So could you advise how can someone balance using cash or CPF to pay for housing? I would say this person probably is in his or her 20s, because he or she is asking, would you advise somebody in their 20s to invest using CPF? I think we may have gone through some of these points earlier. So maybe to close off, I think we can share some thoughts about this question.
Okay, so I guess young person, investment horizon very long, right? So I would say that looking for, again, that kind of well-diversified stock ETF would help for a young person like this, because they have the advantage of that time horizon to compound their returns, and they could also weather more of the downturns along the way, right? As compared to a more senior person, right? Very nearing the retirement. If let's say that year is supposed to retire and there was a downturn in the market, it's very hard to recover from. Whereas a young person generally will not. So I would say that the cash, and also coupled with that idea that I said that for housing loan is one of the cheapest loan that people can get, right? So one consideration is that maybe the cash can put to harder use again, right? And of course, you must be prudent and make sure you don't over borrow as well.
Yep.
Then the second question is that would you advise someone in their 20s to invest using their CPF? I would say that at the 20s, maybe you are also thinking of using a CPF OA to buy a house, right? Yep. Then you still want to invest. Again, a lot of demands on that, taxing on that CPF account. So I would say that always invest your cash first, because your cash doesn't yield that 2.5% that's in OA. It doesn't yield that 4% in SA. So definitely you want to use the cash to invest first. And in fact, it's better because maybe you'll make some mistakes, blah, 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 right? Whereas when you use a CPF OA, your opportunity cost is bigger. And when you make mistakes, it hurts even more, right? So I would think that using cash first is the primary consideration for them. Yeah. And maybe just one more tip is that I realized that the T-bills now is just is 3.2%, so it's higher than the CPF OA, right? So you can actually invest that where the risk doesn't increase because it's still backed by the Singapore government, right? So that can increase your OA rate from 2.5 to 3.2. Okay, in the meantime, I think this only happens, in this period where interest rate is rising. So you might want to take advantage of that to push it a little bit more. So I think there are some avenues like these options that are available that you can help to increase that yield for even your CPF.
Right. So again, to close off.
Yeah, so I think I will second what Alvin mentioned earlier. So for, in terms of the question upon using CPF for investment. Yeah, so I mean, of course, a lot of investment gurus out there will say the best thing you can do is invest when you're young, which is not wrong because, again, the interest can compound. But using CPF, the opportunity cost is higher. Yeah, so OA is 2.5%, SA is 4%, and you also need to have first set aside 20K, in your OA before you can use the balance for your investments. So, think about the opportunity cost. I mentioned earlier also that CPFIS, in the way it is designed, is really more for knowledgeable investors. Yeah, so you can assess whether it is suitable for you. And whether, in terms of the question on whether to use cash or CPF for housing, we discussed a bit earlier on. But just to add one more point, which is that OA savings can also be your emergency fund. Yeah. So, if you were to, encounter some setbacks along the way in life, let's say temporarily lose your income, there's no cash, no OA contributions, I think you can tap on this pool of money in your ordinary account to tide over the mortgage payments. So typically, we encourage members to set aside at least 20,000, and for the average homeowner, this will be able to last you for more than 6 months of mortgage payments. Yeah. So that is something to keep in mind.
Yeah, those are very great tips. I mean, I used to invest a little bit of my money spent OA. So, I mean, aside from having to beat that 2.5 interest rates, right, I realized that there were quarterly transaction fees also.
Yes.
I mean, there are fees deducted from my OA, which, every quarter I will have to try and recover this amount. I mean, it's like $2+, but yeah, those are still costs associated with investment, which you have to factor in when it comes to, generating your returns, right? Right, so thank you all for all the questions. Very glad to have so many questions, and I'd like to apologize also in case we can't answer every question. But if you do have a question on your personal situation, you can write to us at CPF Board. We will have answers for you. Our customer service officers can answer those questions as well, right? So again, if you have a personal situation that you need some answers for, do write to us. We'll be glad to reply you.